Good afternoon, and thank you for joining us today. My name is Shireen, and I'm the Director of Marketing and Communications from AICB. It is my pleasure to welcome you today to the Joint Committee on Climate Change JC3 Upskilling Sustainability Training Series 3 webinar titled A Passion for Purpose, Delivering a Just Transition to Net Zero. Today's session is in collaboration with Standard Chartered and Zurich. I would like to thank our distinguished speakers for joining us today, as well as the respective teams from JC3, Standard Chartered, Zurich, and AICB for your contributions in putting this webinar together. Before we begin, I have a few housekeeping notes. The microphones of all the participants are automatically muted to minimize disruption to the session. The webinar is also an interactive session, so if you have any questions, please submit your questions online by clicking the Q&A tab. Our presenter will answer your questions during the Q&A session at the end of today's presentation. You may also use the chat function to provide comments and feedback during the session, and kindly note that this session is recorded. If you have to leave the webinar session, please select Leave Webinar on the bottom right of your screen to do so. You can still rejoin the webinar if it's still in progress. Ladies and gentlemen, to begin today's session, please welcome Junior Cho, Country Head of Zurich, Malaysia, to deliver his opening address. Over to you, Junior.
Thank you, Shireen. I'm really pleased to be here to attend the Just Series 3 session, A Passion for Purpose, Delivering a Just Transition to Net Zero. Here at Zurich, we've taken the lead in putting commitments to becoming net zero in our operations by 2030. Which is actually accelerating the group's previous 2050 targets. Now, our priority is to stop adding to the amount of carbon dioxide equivalents, or CO2e, emissions into the atmosphere as we move towards our 50% and 70% reduction goals by 2025 and 2029, respectively. Now, to be honest, we made a lot of progress so far, and we have a clear path to further reducing through utilization of renewable energy and conversion to electric vehicles, also supporting the hybrid work environment and finding new ways for commuting and traveling in a much smarter way, all to reduce our carbon footprint. Now, to be honest, the reality is that despite these deliberate mitigation efforts, it is impossible to reduce to zero emissions by this time frame. So what we're looking to do is to balance the unavoidable residual emissions by funding projects that we think will remove carbon from the atmosphere, but in longer term. Things such as purchase of carbon removal certificates for offset. Now, to be honest, there's no time to wait, and I'm sure you've heard of this many times before, but if there's anything we have to do, we actually have to accelerate. And that's why here at Zurich, we're bringing forward our net zero targets up by 20 years to 2030 from 2050. And really what we hope is not just to provide this focus and to increase and double down on our ambition, but it also to validate the urgency to achieve significant emission cuts and the need to scale up investments in removal solutions now. Now, the Intergovernmental Panel on Climate Change has made it clear that achieving net zero means reducing emissions as much as possible, as well as balancing out any that remain by removing an equivalent amount. Now, it sounds easier said than done. They say that to limit global warming to 1.5 degrees Celsius by the end of the century, we must reduce CO2e emissions by 45% from 2010 levels by 2030 and to net zero by 2050. To stop temperatures rising by 1.5 degrees Celsius or even 2 degrees Celsius above pre-industrial averages, thousands of billions of metric tons of CO2e will have to be removed from the atmosphere over the coming decades. I just want you to have a think on what that means. Now, I want to thank you for joining today, and I'm extremely delighted that you will have the opportunity to hear from two subject matter experts, John and Tracy, who will share their knowledge and insights with us on this topic, and hopefully ignite a collective call to action for net zero by 2050. Thank you.
Thank you, Junior. Ladies and gentlemen, A warm welcome to our panel of esteemed speakers today. John Scott, Head of Sustainability Risk, Zurich Insurance Group, UK, and Tracy Wong Harris, Head of Sustainable Finance Asia, Standard Chartered, Hong Kong. Without further ado, it gives me great pleasure to invite panel moderator Teresa Wong, Chief Risk Officer, Zurich General Insurance Malaysia Berhad, to begin the session. Over to you, Teresa.
Thank you, Shireen, and good afternoon, everyone. To kick off our session today, it's my pleasure to introduce our first speaker, John Scott. John leads Zurich's engagement on sustainability risk, both internally and externally. Over the last 10 years, in his roles as CRO for commercial insurance and head of sustainability risk, John has increasingly focused on global risks, in particular, climate change risks. His unique combination of previous roles and experience in the oil and gas industry and chemicals as well, together with his involvement in many industries and governmental organizations, has given him a deep understanding of the risks and opportunities that climate change presents to companies, governments, and society at large. Over to you, John.
Great, thank you very much, Teresa, and thank you, Junior, for the introduction to this session. I'm really looking forward to this, and I hope you learn a lot from this session, from both myself and from Tracy. So can we move to the next slide, please? So I just want to sort of elaborate a little bit what the task is for all of us on this seminar, and also just sort of globally in terms of dealing with climate change and global warming. So this chart shows really the projected global temperatures in a number of different scenarios by the end of the century. Where we are at the moment is around 1.2 degrees centigrade warming from pre-industrial average levels. And what the Paris Agreement goal set us was essentially a substantially less than 2 degrees target to reduce warming. And just shortly after the COP21, the Paris Agreement in 2015, the IPCC scientists issued a report that essentially said we should really aim to limit global warming to 1.5 degrees as part of a net zero goal by 2050. Because if we exceed 1.5 degrees, there are certain things that happen in the way that the Earth stores and removes carbon or actually resists carbon in the forms of either carbon dioxide or methane. There are essentially natural positive feedback mechanisms which would accelerate global warming to the sort of levels you see on the line on the left, to 2 to 3 to 4 degrees. And once we get beyond 2 degrees, really, and beyond certainly 3 or 4 degrees, we're in a world where a lot of things will change. Not only extremes of heat and cold, but changes in extreme weather patterns, really accelerated land ice melt and sea level rise, all of which contribute to a planet that will be really difficult for the numbers of people who live on the planet today to still exist. And I'm thinking here not only of the physical impacts, but the impacts on supplies of food and water. So really dystopian future, really, if we allow global warming to exceed these 1.5 degree limits aligned with the Paris Agreement goals. But where are we going so far? What's the achievement? And this is these ranges, if you like, in the central part of the chart. Well, we had the COP26 meeting last year. COP stands for Committee of the Parties who were signatories to the Kyoto Agreement nearly 30 years ago. And if we look at the governmental commitments and policies, the current policies, if you like, and the actions that are envisaged with those, we are far from aligned with achieving the Paris Agreement goal. In fact, we look as though we're heading more into the upper reaches of 2 to 3 degrees. If there's full implementation of governmental nationally determined commitments, which these are the reduction commitments, the non-binding national plans for climate action of greenhouse gas emissions reductions, Even if we applied all of those that have been stated so far, we only reduce that a small amount, but get to somewhere like around, on average, 2.4 degrees. And if, in addition to that, governments really fully implement all their long-term pledges, plus these 2030 targets, we have a small chance of getting closer to 2 degrees. And in a really best case scenario, if everybody does everything they say we will do, and not only government, but business and finance, and everybody works together to deliver these things, there's a small chance that we can limit global warming to within 2 degrees. It's a huge task, but that is the task that's ahead of us. And what we're going to explore in this seminar is a little bit, what is it that we can do in the finance sector, whether we're in banking, asset management, asset owners, or insurance underwriting? What is it that we can do together to really help achieve these really important goals to limit global warming? So can we move on to the next slide, please? So what is it that we can actually do? What has to happen? And really in the real economy, the parts of the economy that really are generating greenhouse gas emissions. So there I'm thinking of the really important services that all economies rely on. I'm thinking here of power generation, the use of fossil fuels, for example, to generate power, the area of transportation, and I don't just mean here personal transportation, although that's important, and you heard Junior talk about some of the things we're trying to do in Zurich to reduce our emissions, for example, from reducing commuting patterns or changing commuting patterns and reducing business travel, especially by air. But I'm thinking here also about supply chain emissions. So all the goods that we purchase that come from around the world to your home, perhaps, when you purchase them, they all have to be transported by ships, by trains, by planes. So it's all those kind of emissions, and that part of the economy has to decarbonize as well. And then, of course, there's the industries that deliver the components of infrastructure, really important for all of us. I'm thinking here of iron and steel, cement and glass, not exclusively, there are many others, but these are very big emitters of carbon dioxide as well. And in those so-called hard to decarbonize industries, hard to decarbonize because the fundamental physics and chemistry of the production of these valuable or important materials are hard to change, not impossible. We have to think of other ways to decarbonize those industries. So, for example, like capturing carbon dioxide at the smokestack, if you like, and then taking that carbon dioxide and taking it into the deep underground in depleted oil and gas reservoirs or saline aquifers. That's called carbon capture and storage. That's really important for helping to reduce emissions. And then, of course, in petrochemicals, we make a lot of things out of petrochemicals, not only plastics, but a lot of the IT that you would use, and also pharmaceuticals and so on. And then, of course, agrochemicals, pesticides, and fertilizer, and of course, agriculture more broadly. These are all tremendous emitters of greenhouse gases. So when we think about how to decarbonize the real economy, all the companies in all those sectors have to radically change what they do. They not only have to have plans to decarbonize, they have to implement them. And that really falls under one of three sort of tactics for greenhouse gas mitigation. And that's this in the box here, which is called abatement. So all companies in these carbon intensive sectors need to take measures to either prevent, reduce, or eliminate sources of greenhouse gas emissions in their value chains. And that might be about changing products and services. For example, the oil and gas industry or oil and gas sector moving away from the use of fossil fuels to generate energy or deliver energy to their customers. That might be through electrification, the use of renewables, solar and wind power, or moving to defuels, low carbon fuels like low carbon hydrogen or even biofuels. In other companies, that'll be about changing not only processes, but the design of products that they sell that essentially reduce the emissions. The other really important thing is that over time, and this is what the IPCC scientists tell us, is that if we got any chance of achieving full decarbonization by 2050, really part of the journey is to effectively halve global emissions by 2030. That's a huge task, but something we should focus on, and that's all in this abatement area. Just to give you a piece of data to illustrate the difficulty and the scale of the task, even during the full lockdowns during this recent pandemic we lived through, global emissions reduced by 7%. I mean, that was dramatic. No one was traveling, a lot of industry was shut down. But to achieve net zero, we're talking about reductions of 7% of global emissions year on year. So not just 1 year, but every year. So that's really dramatic. So if we don't achieve the full emissions reduction through abatement, what do we do to get to net zero? Well, we have to remove carbon dioxide from the atmosphere. And this is this box underneath, which we call neutralization, which is essentially either removing carbon dioxide from the atmosphere through the power of photosynthesis, plants removing carbon dioxide, turning it into carbohydrates, and releasing oxygen. And that, of course, is about things like reforestation and afforestation projects. Also, of course, avoiding deforestation. Very important that the tropical rainforests in particular in the Asia-Pacific region, but also the boreal rainforests elsewhere, are maintained and preserved to avoid the actual release of carbon dioxide and methane from the soil in the forest, which is many thousands of years old and lock up huge volumes of carbon. The other way of neutralizing is actually taking carbon dioxide out of the air mechanically, direct air capture, and using pore space and deep underground reservoirs, as I mentioned earlier, to store carbon dioxide deep under the ground. That's a highly technologically or engineering intensive way of doing that. It's very expensive at the moment. I think with scale economies that becomes much cheaper, but has the benefit compared to afforestation or reforestation projects of much greater permanency. So this whole area is something that needs to be financed and scaled up dramatically. So another task for the real economy and for us as financiers to support. And then finally, talking about financial support, this concept of compensation. Now, compensation normally in the English language means giving somebody something for something that's happened. In this context, actually, it's about helping companies effectively finance these abatement and neutralization activities. And that's largely through the development of carbon markets, either regulated markets like the European ETS, which are essentially cap and trade facilities that encourage the participants in those cap and trade schemes to reduce their emissions because it reduces the costs of buying permits to emit, or they're through the voluntary carbon markets, which at the moment are quite very small, but need to be scaled and need to be based on quality underlying projects. And that's really a fundamental issue here. So compensation, development of the voluntary carbon markets in particular, and really sustaining and increasing the carbon price, which at the moment has, since COP26 has actually significantly increased, partly on the basis of speculation in those markets, but there are many ways of pricing carbon. And essentially, until we price carbon above, at the moment, around about $120 a ton, and in the future to maybe several $100s a ton, as envisaged by the Network for Greening the Financial System, NGFS climate scenarios, and by the International Energy Agency, we have little chance to achieve these goals around abatement in particular, because it's really the economic drivers rather than the ethical drivers that will help make or drive the decisions, business decisions, to invest in abatement activities. So can we move on to the next slide, please? So we've talked a lot about, what's the the environmental situation? What's the challenge for getting to net zero? How do we actually get there through these three things of abatement, neutralization, and compensation? But how does this play out in the finance sector? And I'm going to give you an example here from the insurance industry as part of the Net Zero Insurance Alliance, which Zurich was a founder member of last year when it was created. We were also a founder member of another Net Zero Alliance, the Net Zero Asset Owners Alliance, that has a very similar approach to its theory of change. And all of these sit under the umbrella of GFANZ, which is the Glasgow Financial Alliance for Net Zero, which encompasses not only insurance companies and other asset owners like pension funds, but also asset managers and banks as well. So really this is, whilst I'm giving the example of how this works in the insurance sector, it applies largely to all other aspects of financial services. So if I take these three areas of abatement, neutralization, and compensation, let's explore a little bit about what in practice that might mean. So in abatement, we talked about what has to happen in the real economy in terms of reducing emissions. What can we do in the insurance sector or in the finance sector to support that? Well, I think the really important thing here is to work with our clients, with our customers, to understand what they are actually doing to reduce their own emissions. In some cases, as I give the example in the oil and gas industry, that might mean entirely new business models to deliver decarbonized goods or services. And with those new business models will come new risks. And in some cases, those new risks might be created by implementing new technologies, which in the insurance underwriting space means that underwriters will need to be able to understand what those technologies are, understand the kind of losses that may come from claims when things go wrong with those technologies, and to think how to price that kind of risk. It may require the underwriters, the insurance underwriters, to develop new products, or in many cases, taking existing products that can be repurposed and applied in a different sector, with lessons on how to manage risks from other insurance lines of business or applications in other industry sectors applied to this new business model within in a particular sector. So that's a really important product development and service development activity. And already, actually, we in Zurich are beginning to do things like that. We've got a great example of building sustainable and resilient services, helping our customers and clients understand how actually the change in some of the transition risks will affect their property insurance, for example, and what we can do to help protect their property risks. The other piece here is really also working with clients to help them understand their risk appetite and the role of risk transfer and the many ways in which risk can be managed, and building on this concept of delivering services, not just the standard products that we would offer or risk transfer products we'd offer through insurance. And I think the other really helpful thing is to talk about, from an insurance point of view, is the role that insurers can play in the full life cycle aspects of the material carbon cost of build and recycling in all sectors, especially in the built environment. And I'm thinking here, encouraging the use of adaptation clause coverage and the sort of broad concept of build back better, and also in claims thinking about repair and recycle of white goods, for example, as opposed to always delivering a new product. So all of these things contributing to reduction of carbon emissions. I think in the neutralization space, as I talked about earlier, trying to understand negative emissions technologies is an important thing for financiers. We produced within the Net Zero Asset Owners Alliance a very good report this time last year, which was titled The Net in Net Zero, the role of negative emissions in achieving climate alignment for asset owners. But whilst it was aimed particularly at asset owners, a subset of that including insurers, it applies also to banks and to asset managers. And it's really helpful in really understanding the different negative emissions technologies and their risks, especially the permanency of removal, and the ability to design new insurance products and new financing products to help manage those risks. And there has to be a strong link to the quality of the neutralization projects that underpin carbon markets. And here, actually, I think there's some very, very good work that's been done through the Task Force for Scaling the Voluntary Carbon Markets, which more recently, earlier this year, transformed into a new organization called the Integrity Council for Voluntary Carbon Markets, which is just setting out actually the important principles to help investors understand what are the quality of the projects, the negative emissions projects, whether they're geotechnical or whether they are largely driven by reforestation or afforestation type projects, to understand which are the ones that have got the highest quality and therefore the best to invest in. And I think it's also really important for the finance industry broadly to work with governments and the real economy clients to really understand the specific risks related to this transport and storage of carbon dioxide, and in particular the risks related to storage leaks, or in the case of, this is the kind of permanency argument, in the case of forests, the risks of forest fires or disease or dieback of plants that may affect the effectiveness of the storage. So that's a whole bunch of really important things that need to happen in the neutralization space. And similarly with compensation, and we're going to talk a lot more about this with Tracy, and I can talk a little bit more as well later in the Q&A about what are the kind of investment portfolios or what are the kind of products that we can create, especially in the green bond and impact bond and sustainability bond areas, that could really create the financing vehicles that the sell side can create for the buy side to purchase actually and to implement in the real economy in terms of funding both abatement activities of reducing carbon dioxide, but also this challenge around the neutralization task as well. So maybe we can just move on to my last slide here, and I'll just conclude. So I mentioned the net zero alliances and the important role of the overarching Glasgow Financial Alliance for Net Zero as a way of really driving the net zero activities of the finance sector. And I thought it'd be useful here to share the GFAN's view of the elements of a credible transition plan. And this is important not only for the financial sector ourselves to make sure that we create a credible transition plan, but also that we apply this to our clients through engagement. So there are 4 items here. One is really, it's really important to set targets. And to set targets, you really have to understand what's in your own portfolios, especially your investment or loan books, but for the insurers, our underwriting books as well, books of business. And the targets should cover not only scopes 1 and 2, in other words, the emissions that relate to the activities in your own value chain, so your operational emissions. So for a financial services company, that would be largely the electricity required to run your offices, but also the emissions that come from your employees commuting and business travel. But also the scope 3 targets. And those, of course, are very large for the financial services sector because they're the emissions of the real economy that we finance or invest in. So understanding what our clients do in the way that I've just described is, and setting targets for their reductions, and for therefore our reductions are really important. And so this isn't all about investment, far from it. It's about engagement with the companies that we support financially, our clients, getting alignment with their transition plans and helping drive and deliver decarbonisation. And of course, those targets need to align with so-called just transition principles. Of course, there are societal impacts of a transition like any industrial revolution. People, the impact on lives and livelihoods, on people's jobs. There'll be more pressures on government for delivery of retraining for workers moving from one type of industry to another, or one type of skill set to another. And there may be challenges to manage early retirement, for example, and pension funding. And sort of moving on to this next point about supporting the real economy, I think it's so important to build engagement with especially the sectors in the real economy that are carbon intensive and that are having to make these big changes, but also with governments, with central banks and policymakers within governments, to ensure that the nationally determined commitments that form part of the whole COP process, that these are really aligned with an industrial strategy and green strategy within countries to deliver and help the economies and the sectors and the companies within the carbon intensive sectors decarbonize whole economies. And so that's really important what we're doing right now, actually training people and supplying advocacy. So last two things, really taking meaningful measures to embed net zero commitments in business practices. So making sure that we actually deliver on our net zero targets. And then finally, really importantly, disclosing our activity to stakeholders, whether those are regulators, supervisors, our own investors, our clients, our customers, and to the communities we live and work in. These are all important stakeholders, and really showing where we're making progress and where we need to make more progress. So I'm going to hold it there, and Tracy, I'm going to hand over now to you to introduce Teresa.
Thanks very much, John. I'd like to now introduce Tracy Wong Harris, Standard Chartered's Asia Head of Sustainable Finance. Tracy's expertise in sustainable finance has been instrumental in developing innovative products and solutions, incorporating ESG considerations into banking decisions, identifying sustainable finance opportunities for clients as well. Tracy is also the Vice President and Deputy Secretary General of Hong Kong's Green Finance Association, the Senior Advisor to the Green Building Project of Hong Kong 2050 is now, and an appointed member of the Securities and Futures Commission Climate Change Technical Expert Group. The floor is yours, Tracy.
Thank you. Hello, everyone. Thank you, Teresa, for your kind introduction. And thank you, John, for your extensive sharing for setting the scene for today's JC3 sustainability training. Delighted to be here sharing this important topic. And in this session, I will provide a very quick overview of the current sustainable finance market and the thematic development, and then dive into how a bank like Standard Chartered is accelerating to net zero. Next page, please. Next one. Thank you. So as you can see on the chart here, over the last decade, sustainable finance has gone through tremendous growth. Taking a look at last year as an example, in 2021, the overall sustainable finance market has hit 1.7 trillion US dollar, and it has doubled globally. And the bottom chart highlight that in Asia is almost 3 times. In terms of product-wise, green bond is still the dominant contributor, contributing to over a third of the overall market, with sustainability-linked loan contributing to a quarter. Now, if we can move to the next slide, please. Yes, so I want to also highlight how the overall market has developed. I call this from green to rainbow. So from very early on, the market has started with green. In front of you, you can see a number of international principles. So what guided what is called green, social, sustainability, transition, etc., etc. So from your far left, starting from your far left, the green bond, green loan principle. So for this is the very earliest stage. We can see the sustainable finance capital being used on use of proceed for green projects only, and green and blue follow the same principle. Then later on, we see the development of social, the social loan, social bond principle. And later on, we see the combination of such, which is sustainability. So literally, it's just the green plus social use of proceed still driven. So we call it the GSS market, green, social, sustainability, use of proceed, bonds and loan market. Then, of course, the latest and today's focus also is on transition. So what are the transition financing has been developed? And this is still very nascent in the market. And we have seen climate bond and issue white paper in this perspective. And on your far right, this is sustainability link, which is if you refer to my earlier slide, I mentioned sustainability linked loan is now the second biggest contributor of the overall market, guided by sustainability link loan principle. So this link structure can be applied to many different products, bonds and loan and other financial products. And the differences of this is actually move away from use of proceeds, is can be applied to working capital, a company's working capital, which tied to the company's sustainability strategy and target. I will share a lot more in the case study later on, and how this product can help to facilitate company to transitions. Next slide, please. Next one. Yes, so now let me move to example case study on how a bank like Standard Chartered, our own sustainability journey in terms of how we are accelerating our journey to net zero. So in front of you, this is our long journey. So back in 1997, we already have our ESRM, environmental social risk management team, set up, which is long before the sustainable finance market is being developed, on looking at how a company or a transaction integrating the E and S of the company assessment. And then over time, we have established the sustainable finance team, of course, and then forming a number of policy, including in 2018, our no new coal policy, and also fast track to our last year, we have announced that our commitments to achieve operational net zero by 2025 and finance emissions by 2050. That's effectively a bank scope free. So in order for our finance portfolio to achieve net zero, we need all our clients to achieve to net zero. So on the back of that, last year, we have issued a white paper, our net zero white paper on how we measure, quantify, and disclosing how we look at our finance emissions, and with a number of supporting acts to accelerating this. So let me go through this in detail with you, how we are tackling our finance emissions in the next few slides. Can we go to the next slide, please? Okay, so in our net zero white paper, we have set out and calculate our baseline. So what is Standard Chartered's finance portfolio based on 2020's data on what is our absolute carbon emissions for our finance portfolio. So with that, we deep dive into three key high carbon intensive industries as well. So first, forming the baseline, calculating and disclosing to the world how much of we are emitting from our finance portfolio. And second, on target setting, we have set a interim target running up to 2050. So by 2030, we have set target for the three high carbon intensive industry, on the oil and gas sector, on the metal and mining, and on the power sector. So running between now to 2030, we have a measure on these three key industry, high carbon intense industry. And we have also refreshed our thermal coal stance on how we calculate and measure. Now, last but not least, which is very core of my work, on the green and transition financing. I will take a few slides on how we focusing on, in additional to publishing the white paper, on how we measure and then we disclose, setting interim target for the high carbon intense industry, to the finance piece, the green and transition finance piece. If we may to bring to the next slide. Yes. So on the back of helping our client to accelerating their transitions in order for also us to arrive to our net zero target, we have set aside a 300 billion US dollar on green and transition financing. And we have looked at 8 industry that play a key role, including oil and gas, metal mining, power, which we have set the interim target, and also look at renewable, shipping, aviation, commercial real estate, and automobile area. This 6 key industry on targeting. And next slide, please. And in order to facilitate on the transition financing transactions, in additional to our existing framework, so earlier stage I have set out how the international principle has been played out in the market. And in Standard Chartered, we have long established green and sustainable product framework, sustainable bond framework. So this has been long established, guiding on us what we consider green and sustainable. And on the back of the accelerating our transition target, we have published our own transition finance framework. So I mentioned we published our net zero white paper on how we calculate our finance emissions, carbon emission by industry deep dive. And now this is really specific into transition finance framework. This guides us by what we say that this is a transition finance transaction according to this framework. Let's take a more detail on how we are looking at this. Next slide, please. Just also to call out, transition finance framework is something that like internationally is being developed. So the G20 is actually leading the effort in looking at the transition finance framework, and not many banks or peers in the market has published. So in Standard Chartered, I can say that we're leading the way in this perspective, that we want to help to accelerate this transition finance segment. That's why we also publish this, to avoid any subjectivity on being interpreted of greenwashing, because this is published on our website, so anyone can look at that and how we define our own transition framework. Now, in front of you is this is what guides us on developing our transition finance framework. And I will just call out 3 core principles in this. One is this transition finance framework is asset-based. So we identify a number of key assets that can facilitate the market globally to transition at asset level. Now, these eligible asset or activity need to be 1.5 degree science-based target aligned. Secondly, is it has to be not hamper the development or for the low carbon alternative, or led to lock in carbon intensive asset. Finally, is meeting the safeguard for developing the environmental social risk management framework, meaning that the do no harm perspective, and how we already leveraging our ESRM capability and looking at making sure that the E and the S, the social element, is being justifiable. And that is the thinking and principle how we develop our transition finance framework. Next slide, please. Okay, so a very quick recap on how we're looking at accelerating our finance emissions to net zero. We have published our white paper on how we measure and we disclose our total absolute emission, and we set our interim target for our high carbon intense industry. We publish our transition finance framework, and we have set aside 300 billion US dollar for our green and transition financing. So on top of all that, we have also set up a transition acceleration squad. I think John mentioned earlier about in oil and gas industry, how this segment, high carbon intense industry, need to accelerate to zero, and that involve in potentially change their business model. So we have set up a transition acceleration squad. Essentially, it's a bunch of industry banker in all this high carbon intense industry to provide advisory to our clients on how they can change their business model to accelerating to the transition. So this is a team or resources that we set aside on top of everything. And of course, we will need products. I think John also mentions about the development of product. So I want to give you an overview of what are the available product in the what we offer in sustainable finance within Standard Chartered and the development among this area. So on top of the loans and bond that I think you are very familiar with the audience, I'm not going to spend too much time on it. And we do cut across, like I mentioned, the thematic. So from green to rainbow, including transition financing across loans and bond. In addition, we also have sustainable deposit. So a corporate and can enjoy sustainable deposit from us as well, and as well as sustainable CASA. And all the way to retail product, we also have green mortgages. I think John also mentioned about the real economies, right? It's very important that not just the financial institution or the large corporate can participate into the sustainable finance market, but all the way through to the retail is also very important. So from that perspective, we offer green mortgages, sustainable CASA, and sustainable deposit to our retail client and some of the location as well. Looking to the bottom slide, you can see that in trade finance. So this is particular in the SME or microfinance market. We also have a sustainable finance product cater for the trade finance and derivative. So this can be applied, the derivative can be applied under the similar structure of use of proceed or link structure as well, and also to repo in the derivative segment. And I mentioned ESG advisory, so we have a transition accelerating squad to assist our client to transition. We also have ESG advisory. So for example, a company want to establish their sustainability strategy or TCFD, disclosure and reporting, and we have specific advisory team to offer that. Last but not least, I think John spent a lot of time on the carbon market, the importance of carbon market from compliance perspective and to voluntary perspective. So as Standard Chartered, we have already been facilitating our Asia clients to go into the EU ETS market, which is the EU compliance market. And also we have recently launched our voluntary carbon market capability as well. So both market that we can offer to our client to facilitate this acceleration. Last but not least, there's a new product that we're coming out really specifically addressing on transition is where when a company assign or subscribe themselves for the SPTI target, then we have a product, we have a financing product that we can offer in this perspective as well. So can we go to the next slide, please? So I'm not going to go through a lot of detail here, but I just want to call out that in the regions, as Standard Chartered, in terms of loans and bond perspective, we are #1 in Asia green loans last year, and also we are #1 in ESG high yield bonds issuance in the region. And the top line, these on the right hand side are some leading transaction, and the top lines highlight all the Malaysia transactions on top. So we have done ESG derivative, we have done repo, we have done financing and social category all across in Malaysia already. Now, next slide, please. Okay, how are we doing off time? Okay, so in the next few slides, I want to share some more detailed example on how a transition financing or financing facility that can help company to accelerating their transition journey. So in front of you, this is Etihad, is a the first transition circle in the world that we help and led the transactions for an airway. So as mentioned earlier, aviation is one of the key industry that we look at to helping in transition. So for this structure, we look at two things. We look at transition and sustainability link in one of in two tranches per se, and in the use of proceed framework, we have looked at the development, manufacturing, installation of energy efficiency in aviation technology, and also the R&D in sustainable aviation fuel development. Next slide, please. And the second tranche of that, so what I called out earlier is the use of proceeds. So the money need to be spent in those category that I mentioned. And in this slide, we highlight the link structure. This really looking at the key performance indicator, we call it KPI, on the CO2 emissions for the intensity for the entire fleet on passenger and freight. And then we have set out for the duration of our landing. Every year, there is a target that the borrower committed to achieve. And if they achieve, they can enjoy certain incentive, and if they don't achieve, there is penalty associated to it. And in this case, they will have to commit to purchase offset carbon credit to offset if they miss their target that we set out for during the transition during the life of the transaction. So again, a recap: aviation on a world first aviation transition deal on both use of proceed and sustainability link structure, really focusing on how we can lock in the acceleration on the carbon emission reduction over the life of the transaction, and also in channeling some of the capital into investing in the R&D on sustainable aviation fuel. Next slide, please. Okay. So in front of you, there are a mixture of linked transactions that I want to share with you across different industry. So again, sustainability link structure. So there's two ways of accelerating transitions with basically locking into how a company in reducing and achieving their net zero target. And using a link structure, this structure is a more transparent tool in a way that we can see as a financier, as a lender, we can clearly set out how the borrower need to reduce their carbon emission target over the life of the financing. So in front of you, we have a two semiconductor case. So in so the first one, the top left, and also on the right hand side on the middle one. So we have two semiconductor case where we set out a number of KPI, and the KPI key performance indicator can be across different. It can be wider than just transition as well. Although that this today's topic, we are very focused in decarbonization and transition, but the link structure can be applied across in adjusting on the social area as well. But taking the semiconductors case, you can see that both focus in on GHG reduction, and also one looking at air pollutant emission, water quality, and also on increasing a new renewable structure. And the other one tied to a index, a sustainability index to be maintaining its credibility in a sustainability index as well, the two semiconductor case. And also you can see that there's a gas transaction here. So even in a gas industry, we can use a link structure on looking at the environmental social KPI on how they reduce their carbon emissions over the term. Also, on the CSSC, so the top left, this is a shipping company. So shipping company they have the shipping industry basically has a very clear curve on how shipping industry need to accelerate. So with this lane structure, we basically have the borrower to commit to deliver an even more aggressive carbon or energy efficiency improvement target in more than what the industry is dictating them to do. We look at AER is a typical things that we lock in and look at shipping company. Now, on a the top right, this is PPA, is a private equity company, private equity company that we help to structure the link structure as well. This one I have a specific slide later on going through some more detail in terms of the whole segment. Last but not least, I just highlight on this one, on the one on the Republic of Ghana, the first sustainability link framework that we help Ghana to develop for a solvent structure as well. And with that, let's take a more detailed look on the private equity slide next. Yes. So I think this should be my last slide before I pass the floor back to Teresa and John for Q&A. And I do hope that we can answer your question live. So I will give you some time back. So I will keep it to my 30-minute session. So on here, this is a private equity Asia on this structure. And what did we do? We actually structure the KPI across the E, the S, and G. So we look at, of course, on the G. So the let me make it bigger. So the one, we look at, okay, how do we help the fund to, when they look through to the underlying company, how do they improve their governance on their ESG due diligence when they onboard their underlying company? That's one on the G. And secondly, on the E, of course, we look at the GHG emissions. Reporting and in reduction as well at portfolio and company level. And then we look at, so GHG basically at portfolio level and also at the fund level, the two GHGs. So the E across on portfolio and fund. And last is on S. So I mentioned, so this really a sustainability link is a good tool and helping a company to articulate their sustainability ambitions and target. So on this particular one, we also help to structure on the S, the gender diversity in the portfolio company. So when the fund go and invest into a company, they need to be able to stretch their gender diversity of those at the company level as well. So this is a structure that where we have the KPI across the E, the S, and G. And last but not least, I mentioned sustainability link is a structure that where if you achieve those targets, you can enjoy, you as in the borrower, can enjoy some of the pricing benefits. You will, very typically, we will reduce the cost of funding, interest rate per se for if you can achieve this target. And every year you have to show me whether you hit or not. You hit, then you have some pricing benefit. Now on this structure, if you do not hit the structure, there's a penalty. And this penalty, again, is looking at the borrower to commit to purchase carbon credit. So we call it double green in penalty. So the commitment of purchasing carbon credit in accelerating the whole end-to-end processes in this as well. So with that, I hope that I have given you a good overview on how as a bank that we committing to net zero from operational to finance portfolio, and how as a bank we can help our client to transition from product perspective and from technical advisory perspective as well. So with that, I think I'm spot on with time. I will pass back to you, Teresa and John.
Thank you so much, Tracy. Ladies and gentlemen.
Teresa, I think you've muted. Yeah, can you unmute?
I'm so sorry. I unmuted and then it got muted back. Yeah, so sorry. Thanks very much, ladies and gentlemen. for staying with us. And Tracy, there was really insightful information from the banking and finance perspective. We'll take Q&As now. If you want to have questions, more questions, please do type it on the Q&A chat box. And I will field the first 3 questions that participants have asked. The first question comes from Lian Lim, and the question is addressed to John. He asked how Zurich applies a cap on compensation. For example, percentage of carbon offsets allowable out of total GHG emissions.
So thanks for the question, and it's a great question. I think the important thing here, rather than a percentage cap, is to say that the most important focus and the priority in the next decade in particular are these tasks around abatement. So there's no excuse for companies in the carbon intensive sectors for not getting on with decarbonising what they do. And just using carbon offsets is just not a great focus. You know, if you just offset your emissions, that's not sufficient. And I think, you know, we should take heed of the news last week of an airline in Europe, EasyJet, who actually had a very successful carbon offsetting program, which it offered to its customers. But it just announced actually it's shutting that down and then putting all their focus into decarbonising their actual activities, somewhat similar to what Tracy was talking about with Etihad. So I think that has to be the focus. And whether or not you apply a cap or a limit to that in our engagement with our clients, I think the point is the vast majority of decarbonisation activities have to be practical and within the value chain of the client.
Right. Thank you, John. I hope that answers your question, Lim. The next question is for Tracy. What do you mean by a 1.5 degree trajectory?
Sure. So this is to be Paris Agreement aligned. So last I looked, I think we have now over 130 countries have made their commitment, their net zero commitment. And for us, we look at Paris Agreement aligned. So for the firm, 2050 to be net zero.
Right. Thanks. The next question comes for both speakers. A dollar and cents question. How do you ensure your products are profitable, business-wise, and a competitive cost for your clients at the same time? Have they been profitable so far compared to your non-ESG businesses?
Maybe I'll come into here as well. So basically, in terms of pricing per se, so in terms of use of proceed product, which is well, still most of the market, because if you look at the overall sustainable finance overall chart, that most of the market is still use of proceed, but with the sustainability linked product that is now contributing to a quarter. So in terms of pricing, there is no pricing differences between any use of proceed products now. However, in sustainability link product, there's still a pricing differences where, as I mentioned, it's tied to the incentive and penalty per se. So I would say pricing is not a majority of the product. There's no pricing differences already. And then with sustainability link, and still it has a differences where it tied to the performance of the borrower. And with that said, I think we need to look wider than the direct pricing per se, because I think what we get asked a lot of these questions. So if there's no pricing benefits, why are we doing it, right? So there's multiple reasons. I think there's 3 drivers. One is from regulatory policy space. We have seen tremendous increase that is climate related policy regulations coming into place. And actually, I have heard this a lot as well. This is the only, the regulator would say this is the only area, I mean, in the sustainable finance or climate area, is the only area that people actually ask for regulation. So you can see the demand for regulation in this place. So from a business perspective, from the state perspective, this is happening. It's just it's a matter of time. Secondly is the opportunity. So it's estimated that we need over $100 trillion in order for us to have a chance to arrive to net zero by 2050. So from a company perspective, is about positioning, right? So you see the regulatory development space that is going to hit you sooner or later anyway, and then and whether now you have to make a decision whether I should be positioning to capture this opportunity now, or and not end up in a strangle asset per se, right? So I think from their perspective, it's wider than just a direct pricing comparison per se. But then I think historically, we have a lot of noises in saying that actually issuing a green bond is so much more expensive than a traditional bond. So I think from pricing perspective, is there's no pricing differences. There are some costs, but now it's become less and less, and then some are being subsidized as well. So for example, if you are some market or governments provide a incentive or subsidy, if for SPO, second party opinions on if you issue a green bond or loan in the market, you want to have a second party opinion, there's some costing involved, and that costing is being subsidized by governments already. So in Asia, we see a few major markets already have this in place. So that bring the issuer cost to more level ground on top of the, you know, the pricing, overall pricing, if that makes sense.
Thank you, Tracy.
Yeah, and I'd just add to
John,
that.
if you could supplement, yeah.
Yeah, I
Sorry.
think for a while, people, for several years, people felt you had to forego profitability to do things that had an impact on either environmental, societal, or governance issues. I just don't think that's the case anymore. I mean, you just have to look at the volume of investment that Tracy's talked about as well into ESG. I mean, so many funds have some aspect of ESG to them now, and many of those funds are performing extremely well. And the pricing, there is no difference. I mean, we still apply the same risk management approach and pricing approach to making money, and the same importance focused or placed on fiduciary responsibilities. You know, it's really important to make money. That's what we're here to do for our stakeholders. But at the same time, we can still have a big impact on these goals we've talked about, either decarbonisation or in the broader impact investing world. You know, these metrics around intentionality, measurability, additionality, as well as profitability.
Thank you, Tracy and John. The next question, they're all coming fast and furious, these questions. It's for Tracy. How big is the US 300 billion set aside for green financing as a percentage of your capital base? What do your shareholders say about this huge commitment?
So we don't look at this at direct. I mean, this we look at from green and transition, how much we help the client to facilitate in the market. So I don't have the percentage of capital per se, but then what we know and is important to us as a bank, we need to transition. So as in how much we need to be doing business, we need bigger of that portion to be green and transition.
Well said. Yes. The next question comes for both of you. There are challenges to financing and ensuring oil and gas and IPP in the power sector. How have you approached these?
So let me start off with this. So in my opening remarks, I mentioned that, you know, one of the big carbon intensive sectors is power generation. So, you know, that's and if you look at fossil fuels more broadly, fossil fuels contribute to a very large percentage of global emissions. But the reality is there's no point in addressing fossil fuel supply if we don't at the same time address the issues of reducing fossil fuel demand. The two kind of have to go hand in hand. And if you actually look at the global energy crisis that we're in at the moment, sort of triggered actually not by investment, but by the geopolitical situation following Russia's invasion of Ukraine, and then the sanctions imposed on Russia that have had a big impact on the energy market. We can see what happens if you constrain supply without reducing demand. You get incredible commodity price increases, generating all sorts of other economic impacts from general increase in inflation and central bank response in terms of interest rates. So this is not a simple task. But I think at the margins, what's really clear is that, and we've certainly done this as an organisation, is it's pretty easy to work out from the data which parts of the fossil fuel sector are the most carbon intensive. And really, if you look at all fossil fuels, the most carbon intensive fuels to burn are thermal coal, often used for power generation, and on the life cycle basis, the carbon intensity of extra heavy oil and bitumen, that includes what's often referred to as oil sands, because that requires a very intensive production process. So it's relatively easy to say, okay, directionally, we should not be investing in those kinds of activities. And in fact, if you look at the science-based energy system models, it says on thermal coal really in OECD nations needs to be stopped or stop the use of thermal coal for power generation by the early 2030s, and actually globally by 2040. Now that's a massive challenge for many sectors or many geographies, especially I think Southeast Asia or Asia in general, because an awful lot of electricity is generated from thermal coal. It's also a challenge for the economies that provide the thermal coal, in particular Australia, but other countries in the Asia Pacific region, Indonesia included. So what do we replace that with? Well, fortunately, in the renewable sector, the incredible increase in supply of solar panels and photovoltaic panels, that is, and also wind turbines, has reduced the kilowatt per hour cost of those technologies truly significantly. I mean, way below what thermal coal produces or requires. So I think it becomes just a question of economics and planning. Just moving from fossil fuels, especially thermal coal, to renewable energy for power generation is just an economic reality. And I think that's happening around the world. It's certainly growing extremely rapidly, renewables, but we've got to invest significantly more of that, and countries need to build that into their power generation plans.
Yes, I would agree with John. I think it's about the model and how the business model evolve and transition. So of course, as a firm, I can't hide from it. I mean, we have a hard stand on no new financing. I mean, no new financing to coal, thermal coal, and have a reliance that it has more than 5%. But from there, but we have seen a lot of our client actually is looking at, okay, what is the transition trajectory? How can we help? And that's where our transition accelerating squad can come in to provide that kind of work with the client effectively about their transition trajectory and how we can make sure that we are there for helping them on their business model to transition as well.
Thank you both, Tracy and John. Next question is on the imposition of KPIs and SPTs onto borrowers of a sustainability-linked facility. How much operational resources are set aside to audit and validate the borrower's report of their performance against these KPIs and SPTs?
Very quick questions. If you look at the latest SLLP, Sustainability Linked Principle, so what is asking to do is for all the SPT to be externally verified. So when we write, when we transact it, we already have to write it in the financial agreement and say that when you send in your SPT, how is that being externally verified? Is that on your is it on, if it's on your existing sustainability report, is your report being audited, and is that audit sufficient to demonstrate those data are valid, or are those KPI linked to external certification that is independent? Or if not, then when they send in those targets, it needs to be on a certificate that been signed off by some external verifier. So I think this is part of the principle already. And it might, I mean, from the bank, we hold this very firmly to be aligned to this international principle. So we hold it absolutely essential when we actually structure this transaction in the market. Of course, you can say that it might not across because the principle is not mandatory. So maybe by other financial firm might not be executed as such, but at Standard Chartered, we are really holding this external verifications as one of the essential in order for us to label that transaction as a sustainability link. Is already being updated in the principle this year.
Yeah, and I'd just add to that, if you're going to get involved in impact investing, you have to measure what you do, because only what gets measured gets done. And I think there's two sides to this. One is about the companies who are financing, who are delivering these benefits. They have a responsibility to disclose. And there are many frameworks that are currently voluntary, but increasingly becoming more required in some jurisdictions by regulation for companies to disclose various aspects of especially carbon emissions. But then on the other side, it's as you're asking in your question, how much resource does it take to do that? Well, of course, it takes some resource, and in fact, in some impact measurements, it's just too expensive to measure things in incredible detail. So I think here it's really just important to follow some of the impact measurement frameworks that are beginning to be developed by, for example, the Global Impacting Investment Network, GIIN. They have an impact reporting and investment standards following, and Tracy has already mentioned the Green Bond Principles, harmonized impact or harmonized framework for impact reporting. So I think following these things is just really important, and being pragmatic about what we measure and how we measure it is also important too. But just remember, we need to generate some profit of these things for to deliver our fiduciary responsibilities, as well as our responsibilities in terms of ensuring that the investments we make actually deliver the impacts we require.
Thank you, John and Tracy. I'll switch the topic from KPIs to another topic. There's a question on what's the view on plantation, palm oil financing, and how one would structure the loan. Tracy?
Yeah, maybe I have a very quick one. So as I mentioned, before I can do any sustainable finance transaction, it has to go through our ESRM team, environmental social risk management team. And given that palm oil is one of the sensitive area, has a lot of social impact element, we really assess that case by case, and that is really sitting with my risk team.
Yeah, and we would take a similar approach. I think palm oil is really challenging because it's so strongly linked with the issue of deforestation. And at the last COP meeting, as you probably saw at COP26, a number of countries, especially those with large forests, got together to agree to stop deforestation by 2030. So I think that's really an important move, and we would want to support that in whatever investments we're doing. So on a case-by-case basis, as Tracy said, it's really important to understand what is actually going on in that sector, or the sectors relating to things like palm oil or deforestation associated with palm oil. And it's not just palm oil, it's in other regions. It's about soy for animal feed. It's about just creating more agricultural land for increased global demand for beef, for example. So having a really strong policy around that is really important. And I think two things there. One in Europe, the European Parliament has just passed a motion actually to make it mandatory for all financial services companies to disclose how their financing will be impacting deforestation. So that's one move that's interesting, would affect the way we would invest. And then the second one is the emerging task force for nature-related financial disclosures, which is kind of like the nature equivalent of the task force for climate-related financial disclosures, the TCFD, that really helped implement or help the finance sector understand climate risks after COP21. So I think when TNFD finally conclude their framework, which will be September 2023, I think it'll be much clearer how we make these sort of nature-related risks link with the financial risks that TCFD has helped us with.
Thank you, John. Thank you, Tracy. The next question is, what's the commercial potential for green product offerings for the retail segment? For example, green deposits.
So maybe I can just well, you go ahead.
Yeah. No,
Tracy. So this is really interesting because actually we won an award last year, actually, Zurich, for a reinsurer or insurer of the year from the Sustainable Investment Awards from Environmental Finance. And one of the things we launched last year was a new unit-linked fund. It's called the Zurich Carbon Neutral World Equity Fund, which combines a low carbon investment strategy with carbon offsetting as an option for our life insurance customers as a sort of investment fund with a tax wrapper around it. So, the really, some great outcomes from that. For example, that fund actually, if you look at it per $1 million invested, there's just 9 tons of carbon dioxide equivalent emitted, compared from a conventional investment strategy where it's sort of seven or 8 times more than that. So really, really a significant opportunity for our retail customers in the life insurance space to access a fund which is having significant benefits for the environment. So that's just one example, and that's something we really want to improve on. So Tracy, over to you.
Yeah, I would just supplement on retail products. So we launched our green mortgage, and it was actually quite positively overwhelmed. And so since the launch, I think within the first few months we launched, the green mortgage coverage of the location we launched is actually gone up to 2 digits of the overall portfolio. So that was quite significant. It's a really positive surprise in how fast actually that stretched through.
Super interesting. Thanks, guys. Next question. Well, we'd like to see the competitive advantages of financial institutions pursuing sustainability finance path in the next 20 years as compared with those financial institutions which are not focused on such measures. So how would you see the competitive advantage? For example, now SCB is forging ahead with sustainable initiatives as well as Zurich. What about your competitors? How do you see this evolving into the next decade?
I see healthy competition across the market because a lot of the transaction actually we have to work across banks. So for loans and for syndication loans and for bond, we actually one transaction it can have 20 banks on, and of course we have ESG lead, so like ESG structure or coordinator, which we are the one driving the whole structure for the deal. So it could be just 1, 2, or 3 banks for the 20 banks in the market. And then, but the other 17 banks still have to approve those structure within that bank. So they see through all this structure. So whoever in the leading role in the ESG coordinator or structuring role, we do all this work. And then it's actually shared within the banking community because they have to go through their own due diligence, or maybe the next time that they have the opportunity to lead and structure, they learn from the other banks. So like vice versa. So it's actually quite healthy competitions happening. And the advantage, I would say, there are clients in the streets where, pricing is essential for everyone. We are still talking about this is a capital market, this is finance market, right? So pricing is essential. But what we have increasingly see is clients looking for that ESG structure ability of that bank. They want to have a big, large syndication loan going to the market. They are maybe a bank with that balance sheet and pricing might not necessarily get into that lead role, but with the ESG capability, we have seen actually client come and say, actually, we want SCB to do this structure, and then can you lead the deal? And then we end up having more major role than we would normally have from that perspective. So I think the whole banking industry, they see that. And then I think it's a healthy competition all around, I say.
Yeah, I think I'd second that. I think what's happening in the world right now is lots of people are valuing the ESG activities, these other activities that come with investing or with loan books. And increasingly as governments getting behind these big net zero commitments, through the regulators and supervisory structures, actually the finance sector is just having to move in that direction, in part to manage our own risks, because what comes to the transition is the risk of stranded assets. So we have to be really selective in the kind of things that we're investing and supporting in. And that makes us stronger. And I think that companies that are less diligent about that kind of analysis when they invest, actually in the medium to long run, actually they're hurt by that, or will be hurt by that. So I think investors understand that, our clients understand that, and whilst I don't begin to think that this is an easy task ahead for the world, as I outlined in my introductory remarks, I do think it's extremely important that we continue on this road.
Thank you, John and Tracy. We have time for just one more last question. For rich countries, they may be much easier for them to switch to clean energy in view of the funding and technology ability. However, for developing countries, they may just start generating power themselves. And due to funding issues, many of them are still using coal power. So how and what could we do to strike a balance in this area?
Well, that's a really good point, and let me set off on this. So I think there's a huge role in emerging markets for blended finance. I think that's really a way of saying that in markets where they have the opportunity to shift very quickly from fossil fuel power production into renewables, that has to be supported. Really by, this is part of the COP process, the so-called loss and damage discussions. And there's a really good example of this that got done after COP26 last year, or around that time, which was the thing called the Just Energy Transition Partnership, where actually some of the sort of northern OECD nations, I'm thinking here the US, some EU member states, and also the UK, so France, Germany, and the UK got together to actually make an initial commitment of, I think it was $8.5 billion US dollars to really support the South African government and Eskom, the major power generator, with a number of different financial instruments, including government grants, concessional loans, various different risk-sharing instruments, which were designed to help accelerate the closure of coal-fired energy plants and accelerate the transition to renewable energy. So, that's a really good example of the type of financing that public financing that then enables private finance to come in, either from investors or from banks, because it removes some of the credit risks associated with those kind of investments, and all aimed at supporting those emerging markets to transition very quickly into renewable energy.
Right. Thanks, John. You want to say something, Tracy?
Sure. I would just add, in additional to, I think this is a precise not problem, and also good problem to have, right? There's huge amounts of funding gap, and we do need the development capital to flow through to the emerging market in order for us to have a chance to arrive to net zero collectively. And from there, in additional to the blended finance structure that John has mentioned, I think we're actually looking for active developed market money looking to be deployed in the emerging market space. So I think it's the transparency, and also when they say green, is it green? So it's the structure, it's the product that to provide that confidence to the investor in the developed market to go into the emerging market. I think that is where the bank has a key role to play. Last but not least, I think just to call out the latest development, something called the Common Ground Taxonomy, which is a development between the EU taxonomy and the China Green Industry Catalog, essentially looking at what are the overlapping common taxonomy being dictated. And we already seeing some bonds and loan being structured in the market. Essentially is to provide another layer of transparency of this loan, this bond, when say green, what does it mean? Does it align with my country in the West, and does it align in the East, per se? So this is a new development that's come out to market. I think it's been positively received, and I think it has a big potential to further grow and narrow this gap, providing really the bridge to bridge the West and the East, develop emerging market in that precise focus.
Thank you so much. Right, we come to the end of the session, and I'd like to invite Muhammad Suhaimi from StanChart to give his closing address. But I also like us to express our thanks to both Tracy and John for sharing their valuable insights with us here today. Thank you. Over to you, Suhaimi.
Sure.
Thank you.
Thank you, Teresa. Bismillahirrahmanirrahim. Assalamualaikum. A very good afternoon to Teresa Wong, Chief Risk Officer at Zurich General Insurance Malaysia, John Scott, Head of Sustainability Risk at Zurich Insurance Group, my colleague, Tracy Wong Harris, Head of Sustainable Finance Asia at Standard Chartered. Ladies and gentlemen, what an honor to be part of this webinar. Thank you to the JC3 committee for the kind invitation, and to AICB for hosting. It's a privilege to be able to represent Standard Chartered on a topic that closely aligned to our own net zero commitment. As you heard clearly from John and Tracy for past 1 hour, the finance sector has an important task at hand in the transition to net zero. Using their network and market expertise, the industry is crucial to provide and moving capital to where it's needed most. With government rolling out initiative to meet the goal of the Just Energy Transition Partnership and the likes, the onus is on the finance sector to complete the circle by providing the financing needed to help communities and companies make the transition. That's what we have taken upon ourselves to do as the Chartered. Only 10 to 20% of the capital required annually to deliver the net zero by 2050 is flowing to the emerging and developing market in Africa, Asia, and Middle East. By leveraging on our footprints in this region and others, we have accelerating sustainable finance and supporting our client in building resilience to physical climate risk as the world moves towards a net zero economy. In Malaysia, as we know, where the realms of the Islamic finance has charted a progressive landscape and continue to show potential for growth, even more opportunity for transition financing present themselves. Islamic banking provides not just an alternative for those who do not use conventional banking due to religious and ethical reasons, which is emphasized on the risk-sharing model between bank and customers, is more accessible to the economically insecure sectors of society. Ladies and gentlemen, thank you very much for your time, for demonstrating your commitment in the transition to net zero through your participation today. Thank you as well as to the speakers for sharing your valuable insight and for advocating the transition. Special appreciation as well as to JC3 for taking up the mantle in leading the climate change agenda. Standard Chartered is proud to be a member of JC3, and we will continue to support sustainable economic growth and development as we embark on our net zero journey, aligned to the Bank Negara Malaysia initiative to accelerate the execution of climate change activity in Malaysia. Thank you to everyone. Thank you very much.
Thank you, Suhaimi. And with this, we have come to the end of the webinar. Once again, thank you, John, Tracy, Junior, Suhaimi, and Teresa. It was a privilege to have you here with us. To all of you who attended today's session, we do hope that you've enjoyed the discussions. Do join us for the next JC3 webinar titled Social Sustainability Towards a Just Transition in November. Before we conclude, do let us know what you think of today's webcast by participating in the webinar survey, which you may access via the link provided in the chat window, as well as via your browser after the session ends. For AICB members, do complete the survey and obtain your CPD hours. With that, thank you again and stay safe. Goodbye.